Imagine you're 23 years old, sitting at your kitchen table with about $11,000 saved up. You have two paths in front of you. One leads to a house, one leads to the stock market. The decision you make right now will shape your entire financial life for the next 3 decades. And here's the thing most people get wrong. There isn't a universally correct answer, but there is a brutal, honest breakdown of exactly what each path looks like year by year, number by number, and experience by experience. Let's walk through both. You're 23, earning just over $3,000 a month after taxes, working a solid mid-level job. Path A, you start aggressively saving for a house, $800 a month into a high-yield savings account. You're disciplined. You know what PMI is. You know what closing costs look like. You start attending open houses just to learn. Path B, you open a Roth IRA and fund it with $500 a month, then open a taxable brokerage account with another $300. You automate everything and barely think about it again. By age 25, here's where things stand. The house saver has nearly $40,000 stockpiled, but still needs more to hit that 20% down payment goal. The investor has a Roth worth around $24,000 and a brokerage account approaching $19,000. Total invested assets about $43,000. On paper, both people have roughly $50,000 in net worth. They look identical. But what those assets are doing is completely different. At 26, the house buyer closes. 3-bedroom home in the suburbs. Purchase price just under $300,000. After the down payment and closing costs, they're $70,000 lighter. The mortgage payment comes in at over $2,000 a month. Old rent was $1,200. That $800 gap doesn't disappear. It gets absorbed by maintenance reserves, furnishings, repairs, and the reality of actually owning a home. The investor, meanwhile, takes that same cost difference and funnels $700 of it into more index funds. Monthly investment total grows to $1,700. And now watch what happens when compounding gets a few more years to work. By age 29, the homeowner has built up over $90,000 in home equity and about $22,000 in a company 401k. Net worth lands around $120,000. That's real wealth, and it's growing. But here's the tension. Nearly 3/4 of their monthly take-home pay goes toward housing costs. There's not much room to breathe financially. The investor at 29 has a very different picture. Roth IRA sitting at $68,000. Taxable brokerage at $89,000. Total invested portfolio, $176,000. Monthly rent is 40% of take-home. There's flexibility in that budget that the homeowner simply doesn't have. The gap between the two paths at this point is about $62,000 in net worth, and that gap is about to explode. Fast forward to age 35. The homeowner's neighborhood has improved. A grocery store, coffee shops, restaurants, home value jumped significantly. Equity is pushing close to $200,000, plus a growing 401k. Total net worth around $300,000. Not bad at all. The investor? The portfolio has crossed $500,000, $148,000 in the Roth alone. Another $172,000 in the 401k, nearly $200,000 in taxable accounts. Total net worth, roughly $546,000. The gap is now $240,000. But here's what that number misses entirely. The homeowner has locked in a fixed housing payment that hasn't budged in 9 years and won't move for another 21. As inflation quietly eats away at the value of that fixed number, they're effectively paying less and less in real terms every single year. That structural advantage is invisible in any net worth comparison. It's real, and it compounds silently in their favor. The investor's rent, on the other hand, has been raised 5 times in 7 years. Every 60-day notice is a reminder that someone else controls a critical expense in their budget. They've made peace with it because the portfolio more than compensates. But that uncertainty never fully disappears from the calculation. At age 40, the comparison gets genuinely striking. The homeowner has a net worth approaching $556,000. The mortgage has 18 years left, and after that, housing costs collapse to roughly $700 a month in today's terms. Just taxes, insurance, and maintenance. That number rewrites retirement planning completely. If the home continues appreciating and the portfolio keeps compounding, total net worth at 58 approaches $2.1 million. The investor hits 40 with a portfolio of just over $1 million in invested assets alone. Total net worth around $1,088,000. Monthly investment rate has climbed to $3,600. At historical average returns projected out to age 58, that portfolio grows to nearly $4 million. The 4% withdrawal rule would generate $156,000 per year. But rent at 58 is unknown. It could be $2,800 a month. It could be $4,100. It depends on a city and a landlord that haven't entered the picture yet. That variable is real, and it doesn't vanish just because the math is impressive. Let me pause here for a second to share some shocking news about the 2026 housing market. Prices are still near record highs, but affordability has collapsed, and millions of buyers are effectively locked out. Inventory looks tight, but not because demand is strong. It's being distorted by the lock-in effect, where homeowners with ultra-low mortgage rates refuse to sell. The result is a market that feels frozen, but is actually building pressure underneath. If you want to understand the real forces behind all of this and what it means for your money, check out my full breakdown. What's really happening to the housing market in 2026? And continuing with our comparison, by any honest definition of financial success, both paths deliver. Both people become genuinely wealthy. The paths converge in outcome. What they don't share is experience. The homeowner learned their neighborhood over 14 years. A neighbor brought soup during a rough week. There's a ceiling fan in the second bedroom that wobbles slightly and never got fixed. And somehow that became part of what home means. The walls hold something that doesn't appear in any investment statement. The investor has lived in 4 cities. Every move was a choice. Every lease was an open door. They crossed $1 million in invested assets before 40 and found out on a Monday morning between meetings. There was no ceremony. Life continued in the same direction it always had. Here's what this really comes down to. Buying a house in your 20s is not a financial mistake, but it requires understanding that you're making a concentrated, illiquid bet on a single asset in a single zip code. You're trading short-term investment momentum for long-term housing cost stability, and eventually that trade pays off enormously. Investing that money instead means building liquid, diversified wealth faster in the early years. The compounding works in your favor with almost frightening efficiency. But you're living in someone else's asset indefinitely, and that cost is never fully under your control. Neither path is reckless. Neither path is obviously superior for everyone. What matters is choosing deliberately, understanding the full cost of both, and then building a system and following it through. Because both paths compound: wealth, stability, freedom, constraint. Whatever you feed your financial system, it grows. The only thing that was ever certain was that the next day would still arrive. And for both of these people, It always did.